Chapter 10 Financial Regulatory Bodies in India. Certificate Examination in Prevention of Cybercrimes and Fraud Management. Subscribe, like, and share. Financial Regulatory Bodies in India. In India, the financial system is regulated with the help of independent regulators, associated with the field of insurance, banking, commodity market, and capital market, and also the field of pension funds. On the other hand, the Indian government is also known for playing a significant role in controlling the field of financial security and also influencing the roles of such mentioned regulators. You must be aware of the regulatory bodies and their functions before a final say. The most prominent of all is RBI, or Reserve Bank of India. Let us look in detail about various financial regulatory bodies in India. RBI, Reserve Banks of India. Reserve Bank of India. Reserve Bank of India is the apex monetary institution of India. It is also called as the central bank of the country. The Reserve Bank of India was established on April 1, 1935 in accordance with the provisions of the Reserve Bank of India Act, 1934. The central office of the Reserve Bank was initially established in Calcutta but was permanently moved to Mumbai in 1937. The central office is where the governor sits and where policies are formulated. Though originally privately owned, since nationalization in 1949, the Reserve Bank is fully owned by the Government of India. The central office is where the governor sits and is where policies are formulated. Though originally privately owned, since nationalization in 1949, the Reserve Bank is fully owned by the Government of India. SEBI, Securities and Exchange Board of India. Apart from RBI, SEBI also forms a major part under the Financial Body of India. This is a regulator associated with the security markets in Indian territory. Established in the year 1988, the SEBI Act came into power in the year 1992, 12th April. The board comprises of a chairman, whole-time members, joint secretary, member appointed, deputy governor of RBI, secretary of corporate affairs ministry, and also part-time member. There are three groups which fall under this category, and those are the investors, the security issuers, and market intermediaries. FRA, Pension Fund Regulatory and Development Authority. Pension Fund Regulatory is a pension-related authority, which was established in the year 2003 by the Indian government. It is authorized by the Finance Ministry, and it helps in promoting income security of old age by regulating and also developing pension funds. On the other hand, this group can also help in protecting the interest rate of the subscribers, associated with the schemes of pension money along with the related matters. FRA is also responsible for the appointment of different other intermediate agencies like pension fund managers, CRA, NPS Trustee Bank, and more. FMC, Forward Markets Commission. Other than the financial bodies mentioned above, FMC also plays a major role. It is the chief regulator of the commodity MCX, NCDEX, NMCE, UCX etc. of the Indian futures market. As per the latest news feed, it has regulated the amount of 17 trillion rupees under the commodity trades. Headquarters is located in Mumbai, and the Financial Regulatory Agency is working in collaboration with the Finance Ministry. The chairman of FMC works together with the members of the same organization to meet the required ends. The main aim of this body is to advise the central government on matters of the Forwards Contracts Act, 1952. IRDA, Insurance Regulatory and Development Authority. Lastly, it is better to mention the name of IRDA, or Insurance Regulatory and Development Authority, as a major part of the financial body. This company is going to regulate the apex statutory body, which will regulate and at the same time, develop the insurance industry. It comprised of the Indian Parliamentary Act and was passed duly by the Indian government. Headquarters of this group is in Hyderabad, and it was shifted from Delhi to Hyderabad. These are some of the best possible points, which you can try and focus at, while dealing with financial bodies of India. The Reserve Bank of India issued new guidance in April 2011 for banks to mitigate the risks of use of information technology in banking operations. RBI guidelines are a result of the working group's recommendations on information security, electronic banking, technology risk management and cyber fraud. The working group was formed under the chairmanship of G. Gopalakrishna, the executive director of RBI, in April 2010. The guidance is largely driven by the need for mitigating cyber threats emerging from increasing adoption of IT by commercial banks in India. Recommendations are made in 9 broad areas, including 1. IT governance emphasizes the IT risk management accountability on a bank's board of directors and executive management. Focus includes creating an organizational structure and process to ensure that a bank's IT security sustains and extends business strategies and objectives. 2. Information security, maintaining a framework to guide the development of a comprehensive information security program, which includes forming a separate information security function to focus exclusively on information security and risk management, distinct from the activities of an information technology department. These guidelines specify that the Chief Information Security Officer needs to report directly to the Head of Risk Management and should not have a direct reporting relationship with the Chief Information Officer. 3. IT operations, specialized organizational capabilities that provide value to customers, including IT service management, infrastructure management, application lifecycle management and IT operations a risk framework. 4. IT services outsourcing places the ultimate responsibility for outsourcing operations and management of inherent risk in such relationships on the board and senior management. Focus includes effective selection of service provider, monitoring and control of outsourced activities and risk evaluation and management. 5. Information security audit, the need for banks to reassess its audit processes and ensure that they provide an independent and objective view of the extent to which the risks are managed. This topic focuses on defining the roles and responsibilities of the audit stakeholders and planning and execution of the audit. 6. Cyber fraud defines the need for an industry-wide framework on fraud governance with particular emphasis on tackling electronic channel-based frauds. Focus includes creating an organizational structure for fraud risk management and a special committee for monitoring large-value fraud. 7. Business continuity planning focuses on policies, standards and procedures to ensure continuity, resumption and recovery of critical business processes. Also, this topic emphasizes implementing a framework to minimize the operational, financial, legal, reputational and other material consequences arising from such a disaster. 8. Customer education, the need to implement consumer awareness framework and programs on a variety of fraud-related issues. 9. Legal issues defines the need to put effective processes in place to ensure that legal risks arising from cyber laws are identified and addressed at banks. It also focuses on board's consultation with legal department on steps to mitigate business risks within the bank. Background: technology has become a part of all walks of life and across all business sectors, and even more so in banking. There has been massive use of technology across many areas of banking business in India, both from the asset and the liability side of a bank's balance sheet. Delivery channels have immensely increased the choices offered to the customer to conduct transactions with ease and convenience. Various wholesale and retail payment and settlement systems have enabled faster means of moving the money to settle funds among banks and customers, facilitating improved turnover of commercial and financial transactions. Banks have been taking up new projects like data warehousing, customer relationship management and financial inclusion initiatives to further innovate and strategize for the future and to widen the reach of banking. The dependence on technology is such that the banking business cannot be thought of in isolation without technology. Such has been the spread of technology footprints across the Indian commercial banking landscape. Developments in IT have also brought along a whole set of challenges to deal with. The dependence on technology has led to various challenges and issues like frequent changes or obsolescence, multiplicity and complexity of systems, different types of controls for different types of technologies/systems, proper alignment with business objectives and legal/regulatory requirements, dependence on vendors due to outsourcing of IT services, vendor-related concentration risk, segregation of duties, external threats leading to cyber fraud/crime, higher impact due to intentional or unintentional acts of internal employees, New social engineering techniques employed to acquire confidential credentials, need for governance processes to adequately manage technology and information security, need for appreciation of cyber laws and their impact and to ensure continuity of business processes in the event of major exigencies. Technology risks not only have a direct impact on a bank as operational risks but can also exacerbate other risks like credit risks and market risks. Given the increasing reliance of customers on electronic delivery channels to conduct transactions, any security-related issues have the potential to undermine public confidence in the use of e-banking channels and lead to reputation risks to the banks. Inadequate technology implementation can also induce strategic risk in terms of strategic decision-making based on inaccurate data/information. Compliance risk is also an outcome in the event of non-adherence to any regulatory or legal requirements arising out of the use of IT. These issues ultimately have the potential to impact the safety and soundness of a bank and in extreme cases may lead to systemic crisis. Keeping in view the changing threat milieu and the latest international standards, it was felt that there was a need to enhance RBI guidelines relating to the governance of IT, information security measures to tackle cyber fraud apart from enhancing independent assurance about the effectiveness of IT controls. To consider these and related issues, RBI announced the creation of a working group on information security, electronic banking, technology risk management and tackling cyber fraud in April 2010. The group was set up under the chairmanship of the Executive Director Sri G. Gopalakrishna. The group delved into various issues arising out of the use of information technology in banks and made its recommendations in 9 broad areas. These areas are IT governance, information security, audit, IT operations, IT services outsourcing, cyber fraud, business continuity planning, customer awareness programs and legal issues. Major recommendations of the working group. The group felt that the recommendations are not one-size-fits-all and the implementation of these recommendations need to be based on the nature and scope of activities engaged by banks and the technology environment prevalent in the bank and the support rendered by technology to the business processes. On IT governance, banks need to formulate a board-approved IT strategy/plan document. An IT policy needs to be framed for regular management of IT functions and ensure that detailed documentation in terms of procedures and guidelines exists and are implemented. The strategic plan and policy need to be reviewed annually. A need was felt to create an exclusive board-level IT strategy committee with a minimum of 2 directors as members, one of whom should be an independent director. All members of the IT strategy committee would need to be technically competent while at least one member would need to have substantial expertise in managing/guiding technology initiatives. A need was felt for the position of CIO in banks, to be the key business player and play a part in the executive decision-making function. The key role of the CIO would be to act as an owner of the IT function and enable the alignment of business and technology. IT steering committee needs to be created with representations from various IT functions, HR, legal and business functions as appropriate. The role of the IT steering committee would be to assist the executive management in the implementation of the IT strategy approved by the board. The IT steering committee should assess whether the IT governance structure fosters accountability, is effective and transparent, has well-defined objectives and actions and unambiguous responsibilities for each level in the organization. The organizational structure for IT should be commensurate with the size, scale and nature of business activities carried out by the bank and the underlying support provided by information systems for business functions. Key focus areas of IT governance that need to be considered include strategic alignment, value delivery, risk management, resource management and performance management. Requirements for trained resources with requisite skill sets for the IT function need to be understood and assessed appropriately. A periodic assessment of the training requirements for human resources should be made to ensure that sufficient, competent and capable human resources are available. The board needs to be adequately aware of IT resources and infrastructure available to meet required strategic business objectives and ensure that the process is in place to record the resources available/potentially available to the bank. Performance of IT function should be monitored to ensure delivery on time and within budget, with appropriate functionality and with intended benefits. Banks need to establish and maintain an enterprise information model to enable applications development and decision-supporting activities, consistent with IT strategy. The model should facilitate optimal creation, use and sharing of information by a business, in a way that it maintains integrity, and is flexible, functional, cost-effective, timely, secure and resilient to failure. There is also a need to maintain an enterprise data dictionary that incorporates the organization's data syntax rules. This should enable the sharing of data among applications and systems, promote a common understanding of data among IT and business users, and preventing incompatible data elements from being created. Procedures to assess the integration and interoperability of complex IT processes such as problem, change and configuration management need to exist, depending upon the extent of technology leverage in a bank. An appropriate program and project management framework needs to be implemented for the management of all IT projects, which ensures correct prioritization and coordination for managing project risks. A consistent and formally defined program and project management approach should be applied to IT projects that enable appropriate stakeholder participation and monitoring of project risks and progress for major projects. Formal project risk assessment needs to be carried out and managed on an ongoing basis. The bank-wide risk management policy or operational risk policy needs to include IT-related risks, and the risk management committee should periodically review and update the same, at least annually. IT function needs to support a robust and comprehensive management information system with respect to various business functions as per business needs and in coordination with business personnel, so as to provide inputs for effective decision-making by management components of well-known IT control frameworks such as COBIT. As applicable to each bank's technology environment, may be considered for implementation in a phased manner, providing a standardized set of terms and definitions that are commonly interpreted by all stakeholders. Effective IT control practices and their monitoring are required to avoid breakdowns in internal control and oversight, increase efficiency, use resources optimally, and increase the effectiveness of IT processes. Information on major IT projects that have a significant impact on the bank's risk profile and strategy needs to be reported to appropriate levels of management and undergo appropriate strategic and cost/reward analysis on a periodic basis. Project-level steering committees needs to be created to take responsibility for execution of the project plan, achievement of outcomes and project completion. An IT balanced scorecard may be considered for implementation, with approval from key stakeholders, to measure IT performance along different dimensions such as financial aspects, customer satisfaction, process effectiveness, future capability, and for assessing IT management performance. Banks may also consider assessing their IT maturity level, based on well-known international standards, design an action plan and implement the plan to reach the target maturity level. A forum in India, under the aegis of AUDIT, akin to the Financial Services Technology Consortium in the US, can work collaboratively to solve shared problems and challenges, as well as pioneer new technologies that benefits all banks. An exclusive forum for CIO and senior IT officials of banks, under the aegis of AUDIT, can be encouraged to enable sharing of experiences and discuss issues of contemporary relevance for the benefit of the industry as a whole. On information security, the major role of the board/top management should involve approving information security policies, establishing necessary organizational processes/functions for information security, and providing necessary resources. Each bank needs to create a separate information security function to focus exclusively on information security management. The organization of the information security function should be commensurate with the nature and size of activities of a bank and extent of IT leverage and e-delivery channels. The function should be adequately resourced in terms of the number of staff, their range and level of skills, and tools or techniques. A sufficiently senior level official of the rank of GM/DGM/AGM needs to be designated as the Chief Information Security Officer, CISO, responsible for articulating and enforcing the policies that a bank uses to protect its information assets. Apart from coordinating the information security related issues, implementation within the organization as well as relevant external agencies. The CISO needs to report directly to the head of the risk management function and should not have a direct reporting relationship with the CIO. A board-approved information security policy needs to be in place and reviewed at least annually. The policy framework should take into consideration, inter alia, aspects like alignment with business objectives, the objectives, scope, ownership and responsibility for the policy, information security organizational structure, information security roles and responsibilities, exceptions, knowledge and skill sets required, periodic training and continuous professional education, compliance review and penal measures for non-compliance of policies. Risk assessment is the core competence of information security management for a bank. The risk assessment must, for each asset within its scope, identify the threat/vulnerability combinations that have a likelihood of impacting the confidentiality, availability or integrity of that asset, from a business, compliance and/or contractual perspective. Job descriptions, including roles and responsibilities, employment agreements and policy awareness acknowledgements from staff increase accountability for security. Management can communicate general and specific security roles and responsibilities for all employees based on their job descriptions. Management should expect all employees, officers, and contractors to comply with information security and/or acceptable use policies and protect the institution's assets, including information. Digital evidence needs to be considered as similar to any other form of legal proof. It needs to withstand challenges to its integrity, its handling must be carefully tracked and documented, and it must be suitably authenticated by the concerned personnel. A policy needs to be in place in this regard. Maintaining detailed inventory of information assets and classification of information/data are among the key components of information security management. Banks need to grant authorization for access to information assets only where a valid business need exists and only for a definite time period for which the access is required. Personnel with elevated system access privileges should be closely supervised. Information security needs to be considered at all stages of an information assets, like hardware, software, life cycle, which typically includes planning and design, acquisition and implementation, maintenance and support, and disposal, so as to minimize exposure to vulnerabilities. Banks should have a process in place to verify job application information on all new employees. The sensitivity of a particular job or access level may warrant additional background and credit checks. Banks should implement suitable physical and environment controls taking into consideration threats, and based on the entity's unique geographical location, building configuration, neighboring entities, etc. There is a vital need for initial and ongoing training/awareness programs on information security for employees and vendor personnel. There should also be a mechanism to track the effectiveness of the training programs periodically through an assessment process designed for testing the understanding of relevant policies. A robust incident management process needs to be in place to maintain the capability to manage incidents within an enterprise, to enable containment of exposures and to achieve recovery within a specified time period. Incidents could include aspects relating to misuse of computing assets, information disclosure, or events that threaten the continuance of business processes. A bank needs to have clear accountability mechanisms and communication plans for escalation and reporting to the board and senior management, and customer communication where appropriate, to limit the impact of information security incidents. Institutions would also need to proactively notify CERT/AUDIT/RBI regarding major cybersecurity incidents. There should be documented standards/procedures for administering an application system, which are approved by the application owner and kept up to date. Access to the application should be based on the principle of least privilege and need to know commensurate with the job responsibilities. Adequate segregation of duties needs to be enforced. Every application affecting critical/sensitive information, for e.g. impacting financial, customer, control, risk management, regulatory and statutory aspects, must provide for detailed audit trails/logging capability with details like transaction ID, date, time, originator ID, authorizer ID, actions undertaken by a given user ID, etc. Other details like logging IP address of client machine, terminal identity or location also need to be available. Alerts regarding use of the same machine for both maker and checker transactions need to be considered. The logs/alerts/exception reports with regard to systems should be analyzed, and any issues need to be remedied at the earliest. The audit trails should satisfy a bank's business requirements apart from regulatory and legal requirements. It should also be facilitating the conduct of audit, serving as forensic evidence when required, and assisting in dispute resolution, including for non-repudiation purposes. Audit trails should be secured to ensure the integrity of the information captured and preservation of evidence. Banks may obtain application integrity statements in writing from the application system vendors, providing for reasonable level of assurance about the application being free of malware at the time of sale, free of any obvious bugs, and free of any covered channels in the code of the version of the application being delivered, as well as any subsequent versions/modifications done. Data security measures need to be in place. Banks need to define and implement procedures to ensure the integrity and consistency of all critical data stored in electronic form, such as databases, data warehouses and data archives. Direct back-end updates to database should not be allowed except during exigencies, in the event of a genuine business need, and after due authorization as per relevant policy. Any changes to an application system/data need to be justified by genuine business need and approval, supported by documentation and subjected to a robust change management process. For all critical applications, either source code must be received from the vendor or a software escrow agreement needs to be in place with a third party to ensure source code availability in case the vendor goes out of business. It needs to be ensured that product updates and program fixes are also included in the escrow agreement. Data transfer from one process to another or from one application to another, particularly in respect of critical or financial applications, should not have any manual intervention in order to prevent any unauthorized modification. The process needs to be automated and properly integrated through straight-through processing methodology with an appropriate authentication mechanism and audit trails. In the event of data pertaining to Indian operations being stored and/or processed abroad, for example, by foreign banks, there needs to be suitable controls like segregation of data and strict access controls based on need to know and robust change controls. The bank should be in a position to adequately prove the same to the regulator. Regulators' access to such data/records and other relevant information should not be impeded in any manner, and RBI would have the right to cause an inspection to be made of the processing center/data center and its books and accounts by one or more of its officers or employees or other persons. Robust system security testing needs to be carried out. Multi-tier application architecture needs to be implemented for critical e-banking systems like internet banking, which differentiate session control, presentation logic, server-side input validation, business logic, and database access. A bank needs to have a documented migration policy specifying a systematic process for data migration and for ensuring data integrity, completeness, and consistency. Explicit sign-offs from users/application owners need to be obtained after each stage of migration and also after the migration process has been completed. Audit trails need to be available to document the conversion, including data mappings and transformations. Banks need to carry out due diligence with regard to new technologies/systems, since they can potentially introduce additional risk exposures. Any new business products introduced, along with the underlying information systems, need to be assessed as part of a formal product approval process which incorporates, inter alia, security-related aspects and fulfillment of relevant legal and regulatory prescriptions. Cryptographic techniques need to be used to control access to critical and sensitive data/information in transit and storage. Banks should only select encryption algorithms which are well-established international standards and which have been subjected to rigorous scrutiny by an international community of cryptographers or approved by authoritative professional bodies, reputable security vendors or government agencies. Normally, a minimum of 128-bit SSL encryption is expected. Constant advances in computer hardware, cryptanalysis and distributed brute force techniques may induce use of larger key lengths periodically. It is expected that banks will properly evaluate security requirements associated with their internet banking systems and other relevant systems and adopt an encryption solution that is commensurate with the degree of confidentiality and integrity required. Banks need to scan frequently for vulnerabilities and address discovered flaws proactively to avoid the likelihood of having their computer systems compromised. Automated vulnerability scanning tools need to be used against all systems in their networks on a periodic basis. Banks need to have monitoring processes in place to identify suspicious events and unusual behavioral patterns that could impact the security of IT assets. The strength of the monitoring controls should be based on the criticality of an IT asset. A bank would need to establish a clear allocation of responsibility for regular monitoring mechanism, and the tools and processes in this regard need to be commensurate with the level of monitoring required. Critical functions, for example relating to financial, regulatory and legal, and risk management, need to be done through proper application systems and not manually or in a semi-automated manner through spreadsheets which pose risks relating to data integrity and reliability. Use of spreadsheets in this regard should be restricted and should be replaced by appropriate IT applications in a phased manner within a definite time frame. Normally, a minimum of 128-bit SSL encryption is expected. Constant advances in computer hardware, cryptanalysis and distributed brute force techniques may induce use of larger key lengths periodically. It is expected that banks will properly evaluate security requirements associated with their internet banking systems and other relevant systems and adopt an encryption solution that is commensurate with the degree of confidentiality and integrity required. Banks need to scan frequently for vulnerabilities and address discovered flaws proactively to avoid the likelihood of having their computer systems compromised. Automated vulnerability scanning tools need to be used against all systems in their networks on a periodic basis. Banks need to have monitoring processes in place to identify suspicious events and unusual behavioral patterns that could impact the security of IT assets. The strength of the monitoring controls should be based on the criticality of an IT asset. A bank would need to establish a clear allocation of responsibility for regular monitoring mechanism, and the tools and processes in this regard need to be commensurate with the level of monitoring required. Critical functions, for example relating to financial, regulatory and legal, and risk management, need to be done through proper application systems and not manually or in a semi-automated manner through spreadsheets which pose risks relating to data integrity and reliability. Use of spreadsheets in this regard should be restricted and should be replaced by appropriate IT applications in a phased manner within a definite time frame. A robust process needs to be in place for effective malware control. Typical controls to protect against malicious code use layered combinations of technology, policies and procedures and training. The controls are of the preventive and detective/corrective in nature. Establishing a robust network protection strategy and layered security based on the principle of defense in depth is an absolute necessity for banks. There should be arrangements for monitoring and reporting of the information security condition of the organization, which are documented, agreed with top management and performed regularly. Security-related metrics can be used to measure security policy implementation. Given the multiplicity of devices and systems, banks should deploy suitable automated tools for log aggregation and consolidation from multiple machines/systems and for log correlation and analysis. Security and audit processes of critical service providers/vendors need to be assessed regularly since ineffective third-party controls can weaken the ability of a bank to achieve its control objectives. Commercial banks should implement ISO 27001-based Information Security Management System and No. 40, ISMS and No. 41, best practices for their critical functions. Additionally, other reputed security/IT control frameworks may also be considered by banks. Strong controls need to be initiated against any remote access facility. The management should establish policies restricting remote access and be aware of all remote access devices attached to the bank's systems. These devices should be strictly controlled. Events that trigger the implementation of a business continuity plan may have security implications. Risk assessments should consider the changing risks that appear in business continuity scenarios and different security postures that may need to be established. Information security assurance needs to be obtained through periodic penetration testing exercises, audits and vulnerability assessments. The assurance work needs to be performed by appropriately trained and independent information security experts/auditors. The strengths and weaknesses of critical internet-based applications, other critical systems and networks needs to be carried out before each initial implementation, and at least annually thereafter. Any findings needs to be reported and monitored using a systematic audit remediation or compliance tracking methodology. Provision of various electronic banking channels like ATM/debit cards/internet banking/phone banking should be issued only at the option of the customers based on specific written or authenticated electronic requisition along with a positive acknowledgement of the terms and conditions from the customer. A customer should not be forced to opt for services in this regard. Banks should provide clear information to their customers about the risks and benefits of using e-banking delivery services to enable customers to decide on choosing such services. In view of the proliferation of cyber attacks and their potential consequences, banks should implement two-factor authentication for critical activities like fund transfers and changing customer-related details through internet banking facility. The implementation of appropriate authentication methodologies should be based on an assessment of the risk posed by the institution's internet banking systems. The risk should be evaluated in light of the type of customer, for example, retail or corporate/commercial, customer transactional capabilities, for example, bill payment, fund transfer, the sensitivity of customer information being communicated to the bank and the volume of transactions involved. While not using the asymmetric crypto system and hash function is a source of legal risk, the banks, at the least, need to implement dynamic two-factor authentication through user ID, password combination and second factor like A. OTP/dynamic access code through various modes like SMS over mobile phones or hardware token, or B. a digital signature through a card/token containing a digital certificate and associated private key, preferably for corporate customers. To enhance online processing security, confirmatory second-channel procedures like telephony, SMS, email etc. should be applied with regard to transactions above preset values, creation of new account linkages, registration of third-party pay details, changing account details or revision to funds transfer limits. In devising these security features, the bank should take into account their efficacy and differing customer preferences for additional online protection. Based on mutual authentication protocols, customers could also authenticate the bank's website through security mechanisms such as personal assurance messages/images, exchange of challenge response security codes and/or the secure sockets layer SSL server certificate verification. In recent times, extended validation secure sockets layer (EVSSL) certificates are increasingly being used. It should, however, be noted that SSL does not provide end-to-end encryption security at the application layer but is only designed to encrypt data in transit at the network. A risk-based transaction monitoring or surveillance process needs to be put in place. The banks may consider dynamic scoring models and related processes to trigger or alert transactions which are not normal to improve preventive/detective capability. Study of customer transaction behavioral patterns and stopping irregular transactions or obtaining prior confirmation from customers for outlier transactions may be incorporated as part of the process. Chip-based cards house data on microchips instead of magnetic stripes, making data more difficult to steal and cards more difficult to reproduce. It is recommended that RBI may consider moving over to chip-based cards along with requiring upgradation of necessary infrastructure like ATMs/POS terminals in this regard in a phased manner. For debit, credit card transactions at the POS terminals, PIN-based authorization system needs to be put in place, without any looping, in place of the existing signature-based system, and the non-PIN-based POS terminals need to be withdrawn in a phased manner. Given that control, security and legal issues on cloud computing are still evolving, a bank needs to be cautious and carry out due diligence to assess the risks comprehensively before considering cloud computing. There needs to be a forum of CISOs who can periodically interact and share experiences regarding any information security threats. It is reported that a CISO forum is already functional under AUDIT. The forum may, among other functions, endeavor to share good practices, identify any specific information security issues and flag them to appropriate stakeholders like the regulator, IBA, etc. There is a need for a system of information sharing akin to the functions performed by FSISAC, Financial Services Information Sharing Agency, in the US. AUDIT as a subset to the banking system can function as a nodal point for information sharing. Accreditation and empanelment of security audit qualifications/certifications and security audit vendors can be considered at a wider level by the Government of India/CERT-in or by AUDIT for the banking sector. In order to reduce the time, cost, and complexity of software assurance and to ensure its security, sustainability and resilience and increase the effectiveness of the methods used by the banking industry for software assurance, an initiative similar to FSTC Software Assurance Initiative, SAI, in the US can be considered in India, possibly under the aegis of AUDIT along with various stakeholders. There is a need for IBA, AUDIT and reputed institutions like DSCI to collaborate and develop security frameworks and detailed implementation methodologies and procedures for the benefit of the banking sector, based on the information security-related aspects covered in this report. There is an increasing need for specific detailed research in security of banking technology and bringing out innovative and secure banking products in collaboration with reputed academic bodies like the IITs. AUDIT can expand its activities/initiatives in this regard. Given the nature of the problem of cybersecurity, there needs to be engagement at a wider level nationally and internationally, with the government, law enforcement agencies, various industrial associations and academic institutions. RBI can consider having a multidisciplinary standing committee on information security with representation from various stakeholders to consider new security-related developments and also legal developments, and based on the same, provide recommendations for suitable updation of guidelines on periodic basis. Collaborative efforts may also be made by reputed bodies like AUDIT, IBF and DSCI coordinated by IBA to create customized indigenous certification courses to certify specific knowledge and skill sets in IT/information security areas for various categories of bank personnel at operational and managerial levels so as to create a large and diverse pool of requisite talent within the banking system.